welcome back. We're going to now review the income statement. We got some good stuff here. Let's calculate our income. So first thing we need to know for the exam, purpose. What's the purpose behind the income statement? Well, number one, it gives us our performance for a period of time. So unlike the balance sheet that's cumulative as of a particular date, this is our performance for this year or this quarter, or whatever it may be. The other thing that the income statement does for us is help us determine operating risk. Are our sales relatively stable from one period to the next or volatile? Is our operating income relatively stable or volatile? So, what elements of the financial statements appear on the income statement? Confidence building question. My friend Regal. The revenues, the expenses, the gains and losses. Now, who's going to be using the income statement? We have a variety of users. We have external users, the investors, the stockholders, common or preferred stockholders. They're very concerned about profitability, which drives value. So they might be looking at not only bottom line net income, but the income that drives value is really the operating income. They want to look at things like return on equity, earnings per share. Then you've got the lenders, short-term and long-term. They're very concerned with the credit worthiness of that company, the company's credit rating. And the credit rating is affected by things like profit margin, EBIT, earnings before interest and tax, because you'll see later on we want to compare EBIT to the interest that's due to see how much EBIT we have to cover that interest. The more EBIT we have to cover our interest, the higher the credit rating. And then you've got the internal users, the managers. They want to know, hey, what's the return on asset for this particular product line, whatever it may be. And all of those users are going to be concerned with risk. Volatility in sales, volatility in operating income, which is generally measured by standard deviation in sales, standard deviation in operating income. Now, be mindful. Most revenues and expenses, not all of them, when you see revenue expense, most of the time you think, hey, that's part of my normal operating activity, okay? Separate line items for the revenue item versus the expense item. We don't net them out. They're both shown separately, kind of gross, okay? Now, you'll see later on there's some exceptions. Interest revenue, interest expense. If you're not a bank, even though I see the word revenue and expense, that's non-operating. You might see other revenue, other expense. Again, even though you see the word revenue or expense, that's going to be non-operating. Okay, not only do we have our revenue and expenses, but don't forget the G and the L. The gains and the losses, okay? The gains and the losses are the non-operating items, no doubt. So for those items, we just show the net result of the transaction. We don't show both the revenue and expense. No, we just show the net gain or loss, which we'll calculate in a second. All righty. Next item we have, cost is not synonymous with expense. Okay, sometimes, well, first of all, your cost is what you pay for something, right? Now, sometimes we take that cost and we expense it immediately. We call that a period cost. The rules say, or we know, hey, this is not going to help us beyond this year, expense it immediately, okay? So these period costs are recurring, selling, general and administrative, maybe our research, whatever, gets expensed immediately. But sometimes we take a cost and we capitalize it, which means we book it as an asset because we reasonably believe that this cost can help us generate revenue in the future. And we know that's all part of the matching principle. So an unexpired cost is an asset, right? When you see unexpired cost, you think asset. That's going to appear on the balance sheet. And then we will expense this in future periods according to what principle? The matching principle. So we give you examples. You buy inventory or construct your inventory. All those costs get capitalized, sit on the balance sheet as inventory. We'll then expense it in the future when we sell it. Match our selling price with the cost of goods sold to measure our gross profit. You prepay for insurance, an asset. We'll expense it over the years or the months of that insurance policy. You have, let's say, PP&E, a factory, a warehouse, whatever it may be, an office building. Whether you buy it or construct it, those costs sit on the balance sheet as an asset. We'll depreciate that. And then when you have intangibles, patent, copyright, trademark, franchise, license, sits on the balance sheet as an asset, we'll expense that in the future, but we don't depreciate that. We depreciate things we can touch. We amortize things that are intangible, and then we deplete natural resources. All of that will be covered later, but that's all part of the matching principle. Okay, now, you need to distinguish between most revenue and expenses, which are part of our core business, versus the other items or the gains and losses, things that are unusual and or infrequent, non-operating. So whenever you see we sold something other than our inventory, or we had to write something down or write something off. That's not like cost of goods sold or SG&A. These things are relatively unusual and or infrequent. You think non-operating, and you look for things like selling something other than your inventory. So you're selling off PP&E. You're selling off an investment in another company, whatever it may be. Or it's not a normal operating expense, not salaries or rent or insurance. Hey, we have to write something down or write something off. That's a loss rather than an expense, okay? Now, why do we emphasize unusual and or infrequent? It could be both. If you've been out of school a while, you got some gray hair like me, you might remember something called an extraordinary item, which was both unusual and infrequent. Years ago, that had a different treatment. Extraordinary items used to have a separate line item on the income statement. No more. Whether you're unusual or infrequent, or unusual and infrequent, some type of natural disaster, fire, flood, hurricane, tornado, whatever, and you got a loss, that's all reported under non-operating, okay? So there's no longer an extraordinary category. So what you need to understand, though, is there's a line item called income from continuing operations, which is actually, as you're going to see, the sum of both your normal operating plus your non-operating, okay? So we'll see more of that in a second. By the way, anytime you have an unusual or infrequent item, you need to tell me about it. What's the nature of the item? How's this going to affect me? That's got to be disclosed, and notice you have an option, either on the face of the financial statement or in the footnotes. Okay, so just a couple of miscellaneous items again to remember. When it comes to non-operating items, we don't report the gross, the selling price, and the cost, the expense. No, we report just the net result of the transaction, the gain or loss. And how do we quantify that? Take your selling price if you sold it, or the net realizable value if it's been impaired, and then you subtract from that the book or carrying value, and there's the net amount, the gain or loss. Income from continuing operations is the sum of Regal, your operating, your revenue, most of your revenue and expenses, and plus or minus your non-operating, your gains and losses, as well as your other revenue, other expenses. Remember, if you're not a bank, even though they're calling it interest revenue or interest expense, those are non-operating, unless you're a bank. The sum of those two is your income from continuing operations. Now, what is not included there? Obviously, discontinued, because not part of your continuing operations. So if you sell off a product line, you sell off, whatever it may be, a separate division in your company, whatever it is, if you sell off and you discontinue a segment of your operations, that is separately reported, and that you will see has its own place on an income statement. It comes after the income from continuing operations, okay? And whenever you have a discontinued operation, not only does it go way down at the bottom of the income statement, but that is reported net of tax, okay? So you'll see later on net of tax when we go through a good example. Now, components of the income statement. Well, if you're a simple guy like me, you like a simple design, right? So we might have what's called a single-step income statement. You take all your revenues and gains, add them together, one line. Take all your expenses and losses except for taxes, because we wouldn't know that tax expense yet. You would get your pre-tax income, figure out then your income tax expense, and then get your bottom line net income. Once you've done that, you can then go back and simplify this even further by taking all your revenues and gains and then subtracting out all your expenses and losses, including the income tax expense that you've already covered, to then get your net income in one step. Now, the problem with this is, or the good news, depending upon how you look at it, no item appears any more or less important than any other item, right? So all your revenues and gains, I don't know what's continuing or not. All your expenses and losses. So it doesn't distinguish between your core business and incidental. That's what a multiple step income statement does. Now, you got to know this inside and out. This enhances user information, and an analyst, a savvy analyst, wants to see a multiple step income statement. They need to separate the operating from the non-operating, because what drives value is the operating, okay? The other thing is, it gives the user of the financial statement readily available information to do ratio analysis. Ratio analysis is very important when assessing performance. Look at this company's margins relative to prior years, trends, or relative to the major competitors. So, ready, here we go. The more times you write it, you hear it, you read it, you'll remember it. Sales minus cost of goods sold, you got your gross profit. Then you isolate just your operating expenses, okay? You know, things like your SG&A, your depreciation, your amortization. Maybe if you're a pharmaceutical company, most of your R&D, whatever that may be, therein lies your operating expenses. You now have that very important subtotal, operating income. This shows you your performance for that year from your core business. And that's very important because normally whatever happening there, since this happens all the time, is sustainable. All right, then we have plus or minus our non-operating items. These are our other items, maybe your other revenues, your other expenses, your gain or loss from the sale of non-inventory, your write-downs, write-offs, whatever. All of that gets then subtracted to get you a line item called pre-tax income. Now, if you don't have any discontinued operation, you'd have your pre-tax income, your tax expense, then your net income. But if you do have discontinued operations, then you'd have pre-tax income, which would really be income from continuing operations before tax. Then you'd have your income tax expense on those items. Then you'd have your income from continuing operations, albeit after tax. So that would get shown twice. Then you would have plus or minus your discontinued operation, which is always shown how? Net of tax. Now you've got your bottom line net income. The beauty of the multiple step income statement is now you can look at that performance, that bottom line, and say, wait a second, what's driving that? Is it the core business or is it things that are unusual or infrequent? Because if net income's going up, your earnings per share is going to go up. Lots of people get excited, maybe not you, because if you see that year's performance was driven by things that are non-recurring, non-operating, while everyone else is buying, you might determine, hey, it's a good time to sell the stock, all right? So we'll see multiple step income statement example in just a minute. Now be mindful, the income statement, like the balance sheet, is not objective. It's subjective. Why? Because the numbers on the income statement and the balance sheet are determined by methods of accounting and lots of estimates. Remember, we're not cash basis, we're accrual basis. We're booking revenues and expenses when the revenue is earned predominantly and the expense in the period incurred to generate the revenue. We're not booking things when the cash is received and the cash is paid. That's the statement of cash flow. So the income statement is outstanding for determining that year's performance, but you know what? It is driven by things that are inherently, susceptible to management bias. Why? Because we could have manipulation through assumptions and estimates. Now, it may be legal, it might be illegal. You have choices. LIFO, FIFO, nothing illegal about one versus the other. Straight line versus accelerated. Useful life and salvage value, you know what? There's some wiggle room there. So what I need you guys to understand is when they ask you, hey, is this company being relatively aggressive or conservative? Anything that leads to more revenue now, you don't defer the revenue. You could have, it's on the fence, gray area, but you decided to book the revenue now, not defer it. Higher revenue and or you choose methods or estimates that that have you booking less expense today. So you took a cost, it's in a gray area, you decided, you know what? I'm going to capitalize the cost. I won't book an expense today. Higher revenue, lower expense. Anything that leads to a higher profit today when there's wiggle room, that's being relatively aggressive. Maybe within the rules, but it's still aggressive. Conservative is choosing methods and estimates where you say, you know what, I'm going to book less revenue today. I'm going to choose a method of accounting that has me deferring more revenue to the future versus booking it today. And when it comes to expenses, you know what? When in doubt, I'm not going to capitalize the cost and book an asset. No, I'll expense it immediately. Any combination of lower revenue, higher expense. If you got a lower profit today, all things being equal, you chose methods and estimates that led to a more conservative assessment of your performance. Now, some of the things we'll learn throughout the course, depreciation. You might use straight line versus double declining balance. If you're choosing double declining balance, well, in the current year, you're going to have a higher expense. You'll have lower profit, relatively conservative. Useful life and salvage value are very important in capital-intensive industry. Anytime companies are choosing a higher useful life, a higher salvage value, that will lead to lower expenses, higher profit. Well, that's relatively aggressive. Bad debts and warranty expense. There's no cash outflow for that. Bad debt. You sold on credit. Some of those people may not pay you. You can't wait to book the bad debt expense. That would violate the matching principle. You estimate it, accrue for it, book it today. But is that expense relatively high or low? Same thing with warranties. General Motors sells a car, 5-year warranty. They can't wait to fix that car. No. They got to book the bad debt expense. The warranty expense, just like the bad debt, in the year they sell the car. So they got to estimate in good faith how much money they'll be spending over the next 5 years or honoring the warranty and book that warranty expense today. Relatively high amount or low amount. Now, you wouldn't know in the abstract whether it's conservative or not. They would give you major competitors, what they're doing, what their percentage is. And if you're using a higher percentage, higher expense, you're being conservative. So, there's no cash outflow for bad debt or warranties, but nonetheless, we have to accrue and book the expense today. In good faith management, we hope, is doing the right thing. Now, the accrual basis system of accounting and the matching principle inherently lead to something called income smoothing. What that means is, you know what? We're not going to book revenue when the cash is received. You might have received it, but it's not yet been earned. Or on the flip side, you might have done the work, you haven't been paid yet, but you don't want your performance that year to suffer because you haven't been paid. So long as you reasonably believe you're going to get paid in the future, you'll accrue for the revenue. So there's no doubt the accrual basis system relative to cash basis is a better assessment of annual year performance. The only downside of accrual basis is it's subjective. On the flip side, some people argue, hey, cash basis, cash in minus cash out. Yeah, it's objective. The problem is not a very good assessment of performance. Again, think of an airline, spends hundreds of millions of dollars buying a fleet of airplanes. Imagine if they had to expense that all in the year that paid for those airplanes. They're going to look like a horrific failure because they're not going to have enough revenue in that 1 year to offset an airplane that's going to last for 20, okay? So the accrual basis leads to some income smoothing naturally to give us a better indication of performance. So the benefit is that helps analysts better predict future performance because they don't have this unnecessary volatility. You'll see later on long-term construction contracts. Let's say a construction company is going to take them 5 years to build a building. Imagine if years 1 through 4, they book no revenue, no expense, no profit. They have to wait until the project is completed in year 5. Well, they're going to look like a horrific failure for 4 years and then have a spike in business. That's not income smoothing. Income smoothing would be, well, hey, if you have reliable estimates of what percentage of the work was done each year, book a little bit of your revenue, expense, and profit each and every year over the life of the contract. This way an analyst can see, oh, I see the work is being done little by little. Better indication of performance. The detriment of income smoothing and accrual basis, sometimes management can take advantage of this and disguise risk and alter performance, try to reduce volatility. And sometimes it's not as obvious as you think. Publicly traded companies in the U.S. have been accused at times where revenues are growing by some ridiculous amount of trying to defer some of that good news to the future. Because then if your revenues grow by 30, 40, 50%, can you sustain that performance? Probably not. So they've sometimes want to defer some of that good news to future years to reduce volatility when they know they can't maintain that year's growth. You shouldn't do that. You book the revenue when it's earned, you book the expense in the period incurred to generate the revenue. Last problem with the income statement is classification shifting. Remember, operating income is up on top, then you have your non-operating below that. Where do you think companies want to put good news? Hey, that's part of my core business. Let's try to find a way to get that in operating. When something bad happens to a company, where do you think they want to put bad news, higher expenses or losses? Let's shift that below and let's call that non-operating. Yeah, it wasn't so good, but don't worry, that's not part of our core business. You can't do that. All right. But classification shifting has happened over time. Companies that commit fraud, that's one of the things they do. Push the good news up, push the bad news down. All right. No bad news here, though. This is all good news. You guys are going to work some questions or watch the next video, whatever you feel like doing. Either way, I'll see you in a little bit.